Hey everyone, it's June 25th, 2015, and in this week's video, I want to give you a quick rundown of our recent performance and touch base on the Dow Jones Transportation Index. So far, we've closed a total of 8 trades. 4 have been winners, 4 have been losers, net on a realized basis. We're up close to 7%. I encourage everybody to visit the website at least once a week. That way you can track your progress and see the trading results match your investment expectations. If they do, you're more than welcome to join, and I'll be more than happy to work alongside you as we build on a trading plan so we can build on consistent gains over time. While at the website, you should also check out our blog forum. It's a platform where I share with you my ideas, views, and expectations on the broader markets. For this week's blog post, I decided to talk about the liquidity break we got in Ambarella. I discuss what constitutes a liquidity break, how you can detect it, and how you can trade it. Part of the reason why I was motivated to write this particular blog post on Ambarella was because liquidity today is 50% of what it was in 2007 in the broader markets. It's an important fact that every investor should keep in mind when investing and even trading. Even though there's a higher share of volume being transacted every day, namely because of the advent of high frequency trading, liquidity, or that capital backstop, is not there. Or at least not as big as it was before. That isn't a problem until it becomes a problem, and that's the issue. You have to be very careful trading the markets, because in any given time, while these liquidity breaks are uncommon, when they do happen, you have to learn how to adapt and respect the price action. With that said, let's take a quick look at the IYT, or the Dow Jones Transportation Index. The biggest components of the IYT are railroad, freight, and airline companies. Railroad and freight companies comprise 75% of the index, and airline companies comprise 16%. What's noteworthy in this chart, on the daily chart of the IYT, is the fact that the index continues to push lower against support, yet we've seen a rally into this week in some of the airline stocks. For instance, if you look at a name like American Airlines, or even a name like Southwest Airlines, JetBlue, all of these names have bounced anywhere between 4, 5, even JetBlue, in the case of JetBlue, close to 10% from the lows, yet the IYT continues to press lower against support. Clearly, freight and railroad companies are to blame. If you look at a name like Union Pacific, it continues to break lower within this accelerated downtrend. Same thing goes for FedEx. The problem I see with this is that should the IYT break lower and confirm a move lower in the index, it most likely not will send other sectors lower with it, as fund managers reallocate or rebalance their portfolios as a way to mirror or readjust their risk profiles to the current market environment. Whether that leads to a 1, 2, 3, 5, or 10% move in the S&P remains to be seen. It's something that can't be assessed right now because we don't know how leveraged any one fund or group of funds are to the IYT or any other sector. It's something we'll have to wait if and when the breakdown occurs in the IYT. Last week I mentioned how there's really 3 possible scenarios that can happen between now and the beginning of fall. We either consolidate between 2063 and 2193, 2063 and 2133 in the S&P 500. We break out higher in the S&P above 2133 and trade as high as 2181 to 2196, thereby consolidating in a higher base. Or we break lower and trade as low as 1920, with 2000, or the year-to-date low, serving as primary support. Either way, there's not much upside or downside. That's something you have to take into consideration. Even if the IYT were to break lower and send the market lower with it, we're looking at no more than 5 to 6% in potential downside. Now, part of the way you can measure a potential drawdown in the S&P is by measuring possible decline of the IYT. One way to do this is by taking a bigger picture or a bigger view of the IYT and applying a Fibonacci retracement on the index from its 2007 high to its 2009 low. You'll notice that the first fib extension came at 136 or comes at 136.36, which is right in line or slightly below the October 2014 low. I should mention that should a breakdown occur, it's likely to be orderly and not happen in one full swoop as most would expect. And you still, even if a breakdown does occur down to this level in the IYT, which is close to 9-10% from current levels, that still puts the IYT up over close to 200%, 180% since the 2009 low. I mean, all the index would be doing if it corrected that low would be to consolidate in a wider range through much of 2015 before the eventual breakout into 2016 and 2017. So, in other words, if a breakdown occurs, not just in the IYT, but in the S&P 500, we'll just be setting up a wider range to trade in and out of. The longer-term trend will still be undeniably to the upside, as will bias and momentum. So that's something I just want to mention. Hopefully you're keeping close tabs on what the IYT does and trading accordingly. Now, if for some reason the IYT were to break above this box that I've highlighted and trade above 153, and the S&P remains pegged towards the higher end of the current trading range, then the current trade we have on right now, which is basically a rotation in and out of sectors, but more specifically from low beta to high beta and into some of the better performing alpha weighted sectors of the last month, will continue. In other words, people will continue to buy the winners, sell them on measured moves to the upside, and sell any gap up we get in some of these names. Long story short, I would get my cue on what the market may or may not do in the short term from the IYT. With that said, thank you for taking the time to listen to the video, and I'll catch you next week. Best of luck trading.